Calculating your capital gain or loss. If you sell stocks, bonds, or other capital assets, you'll end up with a capital gain or loss. Special capital gains or tax rates may apply. These rates may be lower than ordinary income tax rates. Basically, capital gain or loss equals the amount that you realize on the sale of an asset. That is the amount of cash and or the value of any property you receive, less your adjusted basis in that asset. If you sell an asset for more than your adjusted basis in the asset, you'll have a capital gains. For example, assume you had an adjusted basis in a stock of 10,000. If you sell the stock for 15,000, your capital gain will be 5,000. If you sell the asset for less than your adjusted basis in the asset, you'll have a capital loss. For example, again, assume you had an adjusted basis in a stock of 10,000. If you sell the stock for 8,000, your capital loss will be naturally 2,000. Schedule D of your income tax return is where you'll calculate your short-term and long-term capital gains and losses and figure out the tax due, if any. You need to know not only your adjusted basis and the amount realized from each sale, but also your holding period, your taxable income, and the type of asset involved. For that, see IRS publication 544 for more details on that. Now let's talk about holding period. Generally, the holding period refers to how long you owned an asset. A capital gain is classified as a short term if the asset was held for a year or less, and long term if the asset was held for more than a year. The tax rates applied to long-term capital gain income are generally lower than those applied to short-term capital gain income. Short-term capital gain are taxed at the same rate as your ordinary income. Taxable income. Long-term capital gains and qualified dividends are generally taxed at special capital gains tax rates of 0%, 15%, and 20% depending on your taxable income. Some types of capital gains may be taxed as high as 25% or 28%. The actual process of calculating tax on long-term capital gains and qualified dividend is extremely complicated and depends on the amount of your net capital gain and qualified dividend and your taxable income. Type of asset. The type of asset that you sell will dictate the capital gain rate that applies and possibly the steps that you should take to calculate the capital gain or loss. For instance, the sale of an antique is taxed at the maximum tax rate of 28%, even if you held the antique for more than 12 months. Getting help when things get too complicated. The sale of some assets are more difficult to calculate and report than others. So you may need to consult an IRS publication or other tax references to calculate your capital gain or loss. If you would like more information about taxes in retirement, we have a 1-hour webinar about tax changes through the 4 stages of retirement. You see, many aspects of retirement will affect your tax bill in ways different than your working years. Our confusing tax system treats various income types differently and contains hidden taxes and penalties. The webinar link is in the description. It discusses the key tax issues you need to anticipate. See you there.